Morning, everybody. Well done for making it. I'm very pleased to have an audience this morning. As ever, Minds and Money have put together a nice panel for us. So I'm going to be joined by Pim Kalisvaart, Portfolio Manager of Hawke's Point Capital. I'm not going to do long bio introductions, but Pim's got 15 years experience in mining and 10 years in private equity investing in natural resources. So if Pim could come up. We've also got Ross Allister, who's Director and Head of Mining Investment Banking at Peel Hunt. He leads the franchise there. They've got a large number of UK-listed mining companies and were ranked number one in the Extel survey in 2018 and have won various other awards. We also, I hope, are going to be joined by Emily King. Is Emily here? Emily King may be popping up at some point. Emily's the founder of Prospector portal, and she's a geologist specialising in building and leading multidisciplinary teams to achieve clients' objectives in the extractive industries market. And there she is. Fantastic. Sadly, we were due to be joined by Braden Jebson from Torys, the Canadian law firm. Torys are unable to be here, so I'm going to resist the temptation to say, is there a lawyer in the house? And we'll manage without. But I think we've got a decent panel. So I'm going to, and I should introduce myself, Graham Dallas. I work for the Toronto Stock Exchange and the TSX Venture Exchange, based here in London and covering markets in Europe, the Middle East and Africa. We're going to be talking about financing, and I'm going to really not have a huge amount to say myself through the discussion, I think. So I'm going to start off with just a little bit of what I can say on this subject, which is obviously limited to public equity. I mean, it has to be said that through the pandemic, from the TSX and the TSX Venture point of view, financing has been remarkably strong. I think we in the Toronto Stock Exchange and the TSX Venture Exchange are reasonably well positioned to sort of take a view on the public equity sector of segment of financing for mining companies overall, given the market share that we have. About 43% of all the world's publicly listed mining companies are listed on our markets, and over the past 5 years, over a third of all the money that's been raised by public mining companies has been raised on our exchanges. In the first 3 quarters of 2021, we've had 59 new mining listings of various sorts, and the mining companies that we have, 1,100 overall, have raised nearly $8 billion, so well ahead of the total amount raised during the whole of 2020. So the context from the stock exchange point of view in Toronto is that financing has been successful, and I'm going to say strong, but clearly there's a lot more to the world than selling shares in publicly listed companies, and so we're going to talk about that, but other aspects of financing as well. So I'm going to sit down now and hope you can still hear me. Can you hear us, Emily?
Can you hear me?
Yeah, amazing. I'm very impressed. So from my introduction, the market has been quite strong, and equity raising has continued throughout the pandemic. Obviously Zoom and Teams and all those things have been enormously helpful, but presumably it wasn't all done just by people talking to each other like this on video screens. I imagine that there's been a lot of development in technology and data exchange and data availability that's helped to make these fundraisings possible. And I wonder if perhaps starting with you, Emily, we could discuss what those changes or advances or developments have been, specifically around technology and data, that have made it possible.
Yeah, absolutely. I think we found at Prospector that there's a real need for more remote due diligence, right? Which has really required that more data be accessible. It's always been really transparent in the mining industry. The data is out there, but it's been really hard to find. And in particular for the non-traditional mining investors that are now taking a look at the space, it can sometimes be hard to understand. So making that data accessible and not just transparent has been key, not just for Prospector, but a lot of other tools. How can we allow new folks to query all of the big data that's out there about the industry and find the investment that's right for them? As an industry, we focus so much on using technology for operational purposes, right? Remote mines, really well integrated technology at the site level, as well as in exploration with all the great sensors and inversion techniques that come out every year. But it's been relatively new during COVID to use the technology to actually find the investments, I think.
Yeah, interesting. I don't know if Ross and Pim, if you'd like to contribute on that, the availability or usability of data remote with site visits and physical due diligence being certainly harder and maybe in some cases not possible. Are there workarounds that data have made or technology advances have made available to us?
I think from my perspective, yes and no. I mean, it depends on the type of counterparty that you're dealing with. Certainly for public market investors, you can do it all online via Zoom calls because they're probably the last money that's going to come in the door. But if you're a private equity investor or if you're a project finance bank, for example, you can do a lot of the DD remotely. But I don't think there's any sort of alternative to actually going to a site and kicking the tires. That's an essential part of any process. So I think a lot of those type of counterparties would have done the background diligence, a lot of work behind the scenes, and then when they are able to travel, pending kind of COVID restrictions, that they would have to go to site before they'd make any sort of final investment decision.
Yeah, that's certainly our observation. It's helped coming to a site visit more informed, but it doesn't replace it, if that makes sense. So maybe you can make a site visit even shorter because of the homework that you do and the access to data that you have, but it never actually fully replaces actually kicking the tires there and speaking to the people. And it can be as simple as that pearl where the barbecue afterwards, the mine manager just drops a comment that turns out to be, and it can be swing both ways. It can be the comment that makes me want to make this investment, and it can be the comment that makes me want to not do this at any cost. I can't put my finger on it, but there is always something there on a site visit that can't be replaced still at this point by data, but it can make, like I said, it can make me much more educated going into it and much more focused on my list of questions and things that I want to see.
And perhaps even the point, is it worth making the site visit in the first place?
Correct. Yes, it could do that too. Yeah. Particularly the cost of site visits these days, in all sense of the word. Yes, that's a great advantage.
Yeah, interesting.
Graham, if I could add one more comment from above. I think my voice is coming down from above on you guys, but I think what we see our role at Prospector, especially with the use of artificial intelligence and machine learning, is never to replace a human decision, right? But just to de-risk it, as all the panelists are talking about. Maybe identify opportunities that folks wouldn't have seen otherwise, right? Make sure you don't miss a great opportunity, and also help you de-risk it before you go down on site. And like my panelists have said, make sure you're as well educated on that project as you can be before you go down. But absolutely, as a geologist, nothing replaces going down to look at the rocks.
Right. I said at the beginning that from our point of view, the market's been quite strong. The amount of money raised, the number of transactions is well up there so far this year in Toronto. But in any market, there are the haves and the have-nots. So I guess a question that everyone wants to know is what sort of companies do and don't have access to funding in the current conditions? Who's finding it easier? Who's finding it harder? And are there specific groups of metals? I'm sure we can all think of some specific groups, but I'm not going to try and jump the question. So, Pim, would you go first? What are the warm or hot sections and segments, and are there also cold sectors?
I can give my perspective on some of those. But controversially, I would open by saying that mining is not a have sector if I compare it with technology or other sectors that in the last 18 months have had massive influxes of capital. So whilst on a relative basis we feel pretty good as an industry, that's just a reflection of the drought that we've been experiencing for the 5 years preceding that. Right. That said, it's been better than it has been, and it's we're welcoming people. Where I think we're reaching a tipping point is that we're starting to see generalists getting interested in the market, and that is something that we have.
This is always the holy grail at every mining conference, every panel session.
And that is what we're seeing. So I do believe we're reaching a point where we haven't been in a long time. To answer your question, yeah, we do see some haves and nots even within the sector. It's easier for a battery metals company to raise money in a safe jurisdiction with operations in a safe jurisdictions and a project that is largely de-risked, be it technically, financially, permit-wise or other. If you don't tick some of these boxes or any of these boxes, it becomes progressively more difficult. Not impossible, but progressively more difficult. What we also have seen is a whole new market that has opened up, very exciting. We had private equity, and I think the judgment is out. They've been around for coming up to a decade, but we now also have this whole new phenomenon of, again, a tech phenomenon predominantly of SPAC that has now also entered in the mining world. It's a whole new pool of capital, and that could also become available for the right. They're quite prescriptive, so again, the haves can benefit from that. If you don't have some of the attributes that they're looking for, then you're falling between the cracks again. But maybe I can pass it to Ross to add some more of his thoughts.
Yeah, I mean, I would agree with all of that, and I think it was interesting your comments, Graham, about the size of the market in Toronto. I think the difference between Toronto and Australia compared to London, where we predominantly focus, is that mining is a far smaller part of the market here.
Here in London, or
yeah, I mean, if you look at the FTSE 250, I think mining is 4% perhaps of the index. So if you're a generalist investor, you don't have to focus on the sector, and there's a perception that the sector is still riskier than others, and therefore ultimately the upshot of that is that if an investor is going to look at mining, they're going to want the project to be significantly de-risked, and it can be de-risked by having producing assets and cash flow, potentially dividends, or if it's a single asset development play, then commodity, jurisdiction come into the picture, but also you need to have opened yourself up to as many pockets of capital as you possibly can. So typically get your project finance in place, probably go to as many strategics as you can and try and maximize your options, whether that's a larger mining company, whether that's a private equity company, and the public markets capital is probably the last money in the door if you're looking at financing. But it's all about trying to de-risk it from an investor's perspective, and frankly to appeal to as many categories of capital and as broad a universe of investors as you possibly can.
Yeah. Emily, do you have a view on this, on who's from the sort of flows of data and requests that you see on your side, who are the haves and who are the have-nots in terms of sector or stage or geography? Do you have a view there?
Yeah, I would agree with many of the comments that were made, in particular because we built the platform for the generalist investor. So the user data that we see, to speak in generalities, of course, the generalists are looking at gold. They're looking in safe jurisdictions, but it's interesting to see that they appear to be looking primarily for the commodity and the stage versus geography, at least from a search perspective. So I think the message in that is that generalist investors are open to other jurisdictions, probably because they may not yet understand some of the risks that come with some of those jurisdictions from a mining perspective. They may have gone on a great vacation to a certain country and said, hey, I really liked it there, why don't I take a look? And I personally have what I call a fruity cocktail portfolio, so I'm fully supportive of folks taking a look at those types of locations. But it is interesting. The more generalist investors are, more open geographically speaking, but narrower from a development stage, as well as a commodity perspective. Although, of course, as we've seen with the battery metals interest and critical minerals interest, that certainly is something that folks are looking for now that in the past they weren't looking for. And I would consider a new group of generalist investors to be family offices specifically. We're seeing a real uptick in interest from family offices in starting to better understand the market and where could they put some of their capital, which I find to be a really encouraging sign.
It's interesting. I think you're the first person I've heard at this conference so far to mention family offices, but someone did say to me the other day that family offices are the new hedge funds, everyone wants to somehow tap into this magical source of huge amounts of liquidity. So perhaps we could address that. Pim, are you seeing family offices as players in your market?
But yes, we do. But those would be family offices with either a track record in mining or with people in their group that are, geologists or otherwise have the expertise.
Some industrial knowledge, expertise.
Correct. We haven't seen, kind of the generalist family offices for whom it would be the first time. That I haven't seen. I see serial repeaters of the same groups with that knowledge. But I'm very encouraged to hear what Emily said about, if I understand it correctly, more kind of generalist, first-time family offices coming to. It makes a lot of sense if you think about it.
Well, of course it makes sense. Mining makes sense. The problem is we need to get more investors to understand that mining makes sense.
Yeah. And I think the benefit of a family office is that they're not benchmarked versus an index like an institutional investor would be. So they have far more flexibility in terms of deploying the capital. But I would agree with Pim. We've not seen a huge influx of generalist guys, but there are clearly family offices that are probably wanting to play the battery thematic in particular.
Battery metals.
I would have thought so, yeah.
Yeah. A little while ago, maybe a month, 6 weeks ago, something like that, I was talking to another private equity mining specialist, a man called Michael Sherb at Appian, and I asked him about SPACs. This was for a little interview that was we did for a TSX event, and I asked him about SPACs, and he was not very. He didn't think they were a fact. He didn't think it was a very relevant thing. But he was talking from the point of view of his portfolio and his businesses and his approach. But Pim, you mentioned SPACs. Tell me, is it a fact? I mean, you see incredible SPAC deals happening in tech space with things like electric vehicle manufacturers that have never made an electric vehicle, raising billions of dollars through certainly raising hundreds of millions on billion-dollar valuations. For miners?
I can think about 4 or 5 SPACs. If I add up the capital, I'm getting close to $1 billion US, which means that they collectively have to do deals of 2 to 3 billion. The way the SPAC works, you want to have consume a deal that is 2 to 3 times, ideally 4 to 5 times the size. So we're talking about a pool of capital that has a limited life of give or take 18 months, that needs to do a deal on a collective basis of 2 to 3, maybe $4 billion. That doesn't sound like a market we can ignore. And I know for a fact they were in many of the processes, ironically, the Appian process, where they sold their Brazilian mines. So they're actively looking. And like I said, it's 2 to 3, maybe $4 billion that is chasing deals. That's not something to ignore. That's an awful lot of capital. It's half of what gets raised on
the
Canada,
TSX.
If I heard that correctly. Yeah. So it might not be the sheer force it is in the tech market, but it's certainly not something to ignore.
I think it's notable that none of them have de-SPAC'd yet. None of them have found the transaction.
2 of them have.
Have they? Okay.
Yeah, so AMCI has de-SPAC'd one, and then obviously Deep Green has de-SPAC'd.
Okay, yeah.
So there's already 2 that have.
Right. So,
but I mean, I would see it as a natural thing for a private equity group to do, frankly, because it adds another tool to the box in the sense that they will see a huge spectrum of transactions come towards them. Most of the time, they'll be looking to deploy equity or capital across the kind of the structure, but there's obviously going to be times where they see a transaction where they think, well, that's more suitable for the SPAC that's attached to us, and Orion, RCF, McDavis, amongst others, have a SPAC arm almost to the existing private equity group. So it's almost like another vehicle to deploy capital, and it makes sense from that perspective.
Yeah. Interesting. I mean, it would be nice if it did suddenly develop, or even gradually develop into a sort of reliable and steady stream of source of financing, along with the other sort of innovative things that have been developed, like streaming, like royalties and so forth, that have helped the industry to develop over the last few years.
I think the more capital we can attract to the sector, the better fundamentally, and the more transactions that are done, the more interest it's going to generate from different pools of capital. So I think it's a positive development net.
Indeed, yeah. It's actually a rule about this conference that no one's allowed to come up here without talking about ESG, so we're going to talk about ESG. Is ESG driving particular sectors? Obviously, mining as an industry is an enormously important thing for these areas are enormously important to be considered sort of operationally, but in terms of the attractiveness of certain sectors or subsectors of the industry, what is this overarching ESG environment? What's the impact of that specifically on financing, or different types of financing for companies? Can I start again with you, Pim?
Certainly. I think first and foremost, ESG, forget what it's driving. I will come to answer the question of what it's driving, but I think what it's driving most importantly is behavior. And we see lots of changing behavior in the way people conduct themselves, the questions that they ask, and the way they set up their businesses and think about ESG. And I think that's testament to the direction of travel we're in, and the fact that we've all jumped on the bandwagon. So I think that's a positive sim. Out of that comes certainly certain groups that logically see more interest, such as anyone that provides materials that feed into the battery segment. Conversely, if you have a coal mine, then you're finding yourself at the other side of the argument. So there's definitely people who benefit more than others, but we're all still facing similar challenges in that we're in the extractive industry, which by and large raises an awful lot of questions on the ESG perspective. And if you overlay that with the social element of it, and many of us having operations in countries where the social element is also challenging, then there's a whole separate segment that requires focus. And then last but not least, the government side of it, where mining, I guess like other industries, hasn't always covered itself in glory.
Yeah,
but at least it's a real discussion point, and I see it change behavior, and I think that is very, very important.
On both the corporate side
and the financiers, yes. Yes, and it's been remarkable in just the space of 1 year how it's really changed, and it's become a board level and a management level discussion with true buy-in from everyone, as opposed to much more of a niche discussion that it was as recent as 12 to 18 months ago.
Interesting. Ross, what's your take on it?
I, again, agree with everything that's just been said. I think there's far more engagement from institutional investors in particular on ESG. There's specific ESG teams at most institutional investors that will want to understand in detail what certain policies are. Going into an incredible amount of detail, such as where does your power come that you use at your mine site, and if that power comes from coal-powered plants, then
or diesel generated.
Well, it's sometimes challenging. And we had a company that raised money earlier in the year, and an investor was very interested, but the company didn't have a net zero target, for example, and that
company didn't have a stated
exactly,
net zero target.
and that investor can't invest unless someone has a net zero target.
Really?
And so it's challenging for some companies to kind of meet these targets. I think, again, coming back to Pim's point on you're in an extractive industry, it's actually quite difficult to kind
it's
of
a heavy
reach net
industry,
zero.
yeah.
So it's provoked a lot of thinking, and I think changed approaches of management teams. And governance can't be overlooked as well. I mean, I think every grown-up company, their chairman probably has to do an ESG roadshow now each year and ensure that governance is fit for purpose, certainly in the UK. So I think there's completely, behaviours have changed significantly.
Yeah. Emily, would you like to contribute on that point? Has it impacted what you're seeing in your day-to-day business?
Yeah, I think one of the most frequent requests for a new development product is a mining-specific ESG metric that would allow an investor to compare apples to apples and oranges to oranges, which is a real challenge because, as the panel has been speaking about, it's hard to compare a mining company to a tech company, right, when it comes to ESG, or even a manufacturing company. So I think that's a challenge for the industry as a whole. There are some various metrics out there, but for whatever reason, they haven't been really adopted industry-wide to the point where companies can really benchmark themselves from an ESG perspective against each other. And I think that will be key to unlocking this issue for the industry, is everybody agreeing, here's how we're going to measure our ESG targets, but also our performance. I think that's the other big challenge with ESG, is not just where's your target, what's your plan, but have you actually acted on the plan, and can the investor confirm in a way that's relatively independently verifiable that you have implemented the things you committed to. And that's hard because the data on environmental is actually relatively easy to measure, right, and to check. But social and governance issues are very challenging to measure and implement any kind of metric-based accountability.
Yeah.
But it's certainly something people and the more generalist investors, the family offices, many of them consider themselves impact investors, right? So it's absolutely something we need to do in order to unlock that new capital.
Yeah.
And I think it's created some interesting dichotomies in terms of how an investor approaches a company, because you could change from the power supply to your mine, for example, from a coal-fired power plant to a solar plant. Yeah. It's going to have a cost attached to it. Yep. And it's going to increase your cost of production, most likely as well. Yeah. So a fund manager, on the one hand, is probably going to be quite annoyed that, well, it's a higher cost of production, there's less cash flow, there's less income for me. But the ESG guy is going to be happy. So you have to balance that out.
Yeah.
And at the same time as well, you've seen, I guess, different approaches from the majors in terms of how they deal with their coal assets as well. And Tungela's a very interesting example of Anglo spinning out an asset, but actually institutional investors probably selling out, but everyone else who can see the coal price going up probably investing, and that the company's done incredibly well out of it, and the investors that have come into it have probably done very well out of it as well. So there's almost a sort of contrarian view of, well, these assets are going to make quite a lot of money, and so from a personal investment perspective can make sense.
Yeah, I mean, I kind of think that ESG, particularly the E component of it, is harder for mining than just about any other industry sector. You know, you're out working in the natural environment somewhere. What are you going to do to, the world around you, whether it's a desert or a forest? Water use, power source, infrastructure, benefit to the community. I mean, it's a really far more complex. And although I think it's admirable goals to have some sort of benchmarking process that you can look at mining companies against, there's such an enormous variety of different activities covered by the word mining. You know, from a very small operation with some drill rigs on a truck to a massive open cast. But it's a very difficult to benchmark against. I wonder if it's driving people away at the moment because it's too complex. And perhaps some people say that from an ESG point of view, mining, I just can't get my head around it, I'll ignore it. And perhaps the only way to get back then is to be a mining company big enough to be in an index when the passive guys come in. I don't know, I'm sort of speculating now. So
I think it's very easy to get tangled up in the weeds, and I think the fundamental point is that well-run companies will have very good ESG policies, and you can kind of see the ones that come to the surface, and they're probably the ones that are going to make the most money. I think that's the kind of
in the medium to long
fundamental.
term. Yeah. We've got 3 minutes left, so if there are any questions from the floor, this is the time to have them. There's a gentleman at the front.
Morning, Jonathan Molyneux, ERM. There was a speaker yesterday on the platform, I think she was from the Hong Kong Stock Exchange, and I'm sure I heard her mention ESG bonds as a source of funding. It hasn't come up in the conversation today, so I wondered how sort of big a thing that was, and what the speakers know about ESG bonds.
I can confidently say I don't, but I'm going to defer to my banker panellist.
Not in the mining sector, as per se, but we have seen them across other sectors, and we've also seen transitional bonds where the bond is kind of provided on the basis that a company will take certain actions or comply with certain things which will lead to improved environmental standards, for example. It is something we've looked at from a high level, but I think that market is a generalist market and have a perception of mining at the moment. I think potentially in the future we can try and change that perception, but at the moment I don't really see it as a natural source of capital for most mining companies.
Thanks very much.
Do you know if we have any other questions? Can you see anybody? I can't see anybody.
No. Yes, one.
At the back, thank you.
This is Rama Ayman, MMG Capital. MMG Capital. This ESG bond that was mentioned, Polymetal did 2 notes with EBRD and a climate fund, and it was quite interesting because the interest rate was linked to milestones achieved in implementing their ESG plan. So as they implemented the ESG plan, the coupon rate would drop. They did 2 notes, one for I think 400 million, one for 100 million. The tricky part about it is that it is EBRD financing and European Union climate fund. So I don't know whether this would then translate into other funds because the interest rate is going down.
Yeah, perhaps something that's not available to too many potential borrowers. I don't know. Interesting though. I mean, presumably the borrower has other debt. It was quite interesting, this sort of, how do you hypothecate the ESG bond capital compared to other financing that the company is using? It's I can understand why it's interesting, but I think it might be quite difficult to implement in detail. So, are there any other questions? If not, I think. Oh, sorry, we do have a serial questioner at the front.
Again, there was quite a lot of conversation earlier in the discussion about SPACs, and I think it was Pim talked about specifically what they're looking for. I wonder what can we say about what SPACs specifically are looking for in mining investments?
Each SPAC is quite unique. They have a section in their prospectus where they have to be extremely prescriptive in what they do so that the investors who give them the blind pool capital money understand what they go and hunt for. So to pick the easiest example, African Gold Acquisition Corp has defined, as you would expect, in its prospectus that it's looking for gold opportunities in the transaction range of $1 billion plus, of producing assets in Africa, and I think they even put some operational metrics in there. So you will see if you go through the prospectus of each of them, they are quite prescriptive. That being said, they can venture outside of those, but then they still need to seek shareholder approval. So you can see that there's a bit of a risk if you venture too far left, because the shareholders that gave you the money can as well ask, if they're not convinced by your proposition, their entire capital back, which you have an obligation to do. So it's wise and prudent to stick within your pre-described venture, but like I said, you could stray if you can convince people. But if you use your mining money to go and do something completely left field, I think you might find it difficult to get the shareholder approval.
Okay, with that, I'm going to wrap it up. Emily, Ross, Pim, thank you very much, and thanks to you all for listening and participating. Thank you.
Thank you, Graham.